Aloha, everyone. Thank you guys for coming back. Just to piggyback kind of our last question, I wanted to know, what does an investor or a normal person do when the market drops?
Well, that's a good question, and that kind of piggybacks the question that you had before. It depends on if it's a short-term or long-term investor. So if it's a short-term investor, well, I wouldn't give much advice, because if you're going to invest in stocks, you should be a long-term investor. So let's focus on the long-term investor, someone that's got 5, maybe 7 years plus that they don't need those funds for. And I would say, there's a process you go through. But number one is being patient, and also understanding that your investment return is really the investment that you hold times the return, which I call the investor return, which is your decisions. What are you to do? Whether you hold, you sell, or you buy. So with that, we have to understand that volatility is normal. Markets go up and down. The facts are that the stock market on average per year is down about 5%, around 3 times per year. It's down about 10% at least once a year, a little bit more. And it's down 20% at least, I think, every 3 to 5 years or so. And so volatility is part of the game. So when it does go down, well, there's a process if you're a long-term investor. The way I look at it is that, number one, and this is in order of what's the worst thing to do to the best thing to do. And the worst thing to do, I think, is to sell. Sell at the bottom. You're kind of locking in your losses. Number two, if you feel like you need to do something, but you can't, you shouldn't sell, then just do nothing. Be patient. And then 3, the best thing to do probably is to buy. Buy more at the bottom for a long-term investor. Do really well. There's a saying that from a famous investment saying that you make most of your money in a bear market. You just don't know it at the time. And what a bear market is a market that goes down in value. And I don't know if you know this, but the reason they call it a bear market and a bull market, which is a market that goes up in value, a bear market represents a bear, and when they attack, they stand on their hind legs and they attack going down with their claws. And a bull market represents a market that's rising or going up, and the reason it's called a bull market because the bull has horns, and when it attacks, it dips its head and it attacks up, and so it's a rising market. So to summarize, what should an investor do? Well, they should just follow that process as a long-term investor and probably buy more.
Yeah, and a question upon that. So us as humans, I feel like when things aren't going well, we like to take action. We like to do something about it, and that's natural. But I think when that situation happens, a lot of people like to go into cash because they're afraid. They're afraid they go into cash, keep it safe. Should someone do that in that situation?
So no, absolutely not for a long-term investor. And back to that first, the process is step one is the worst thing to do is to sell out and go hide in cash. And there's so many studies that show why that is so. And I'll share one with you, and I have it right here. And this is just from 1928 to 2020. And this is a growth of $10,000 investment. And this is done by Ned Davis Research. And so if you invested $10,000 from 1928 to 2020, and you just left it invested for those years, which is 24,301 days, it was worth $55 million. You just did nothing. But if you missed the 10 best days, only 10 days out of the 24,000 days, then your $10,000 would have grown to $18 million, which is a lot different than the $54 million. Yeah. If you missed the 30 best days, it would have grown to $4.2 million. If you missed the 50 best days, it would have grown to 1.2. That's a huge difference. Yeah. So, and there's 24,000 days we're looking at. So to summarize, and this is really important, is a lot of those best days in the market occur after the worst days. So if you run and go into cash, you have a high risk of missing some of the best rebounds that occur after the worst days. So no.
Cool. Awesome. Thank you.
You're welcome.